Greetings, Single Point clients and friends. Here we are 1 week into the new year, 2020. I just wanted to briefly recap the 2019 market performance, which was pretty significant. U.S. equity markets were up almost 30%, and non-U.S. stock markets were up as well, north of 20%, still a big outperformance by U.S. Those numbers would normally be concerning, because anytime that the stock market runs up that fast and where the rate of growth of stock markets exceeds the rate of growth of the underlying profits of the companies that make up the index, that's usually a cause for concern. But as you may recall, in the last quarter of 2018, we went through a pretty significant sell-off, almost a 20% drop. So what we really want to look at is we want to look at the 2-year average of the return of the market. And if you look at the 18 plus 19 return, you end up at about 23% combined, or about 12% per year average for the US stock market. Unfortunately, for the non-US stock markets, the numbers look like in the low single digits. So US continues to outperform. The average return over the last 2 years is around 12%, which is more in line with the underlying growth rate of profit growth of those US companies. So we're not feeling overly concerned that the valuations have gotten too far ahead of themselves. And in fact, there's a consensus by the marketplace that in 2020 we should see additional profit growth of another 9 or 10% year on year over 2019 profits. That's in the aggregate for the index as a whole, which is it's not an unobtainable number. We think that it's certainly feasible, and therefore we feel pretty good about where valuations are heading into 2020. I want to reflect a little bit on the one issue that we continue to be very vigilant of, and that's inflation. It's no secret that throughout this expansion, a lot of companies have taken on a lot more debt to finance their expansion. Usually, excess debt is kind of the mortal sin that usually can lead to pretty significant recessions. If the Fed raises rates and a lot of these companies are carrying too much debt, then you can see how companies might get into trouble. So we pay a lot of attention to inflation, which is the metric that the Fed uses to either raise or lower rates. At this point, I think there's general consensus as well that the Fed is likely to stay put until inflation statistics begin to show a little bit greater inflation growth. But for now, things look pretty good on the inflation front. And even though we're not complacent about the risks around there, we certainly feel comfortable staying fully invested in the equity markets as we start out in 2020. So with that, I welcome an opportunity to answer any emails or calls, questions you may have. Happy New Year, and thanks again for your business.